In late 2021, Bitcoin was trading for nearly $69,000 per coin, making investors rich overnight. However, things took a drastic turn when the cryptocurrency market crashed in May 2022, causing Bitcoin to plummet below the $20,000 mark. To make matters worse, in June of last year, Bitcoin dropped by a staggering 30%, followed by another dip in late October. But don't lose hope just yet. The year 2023 has seen a powerful resurgence in the digital asset markets, with Bitcoin rallying over 40% from its low of just over $16,000 to almost $24,000. However, even with this surge, Bitcoin is still over $65,000 lower than its all-time high value, with other cryptocurrencies facing similar setbacks. During these tough times, investors often push the adage, buy the dip, hoping that these lows are merely temporary downturns rather than a long bear market. But is it a wise move? Let's find out. The phrase buy the dip refers to a fundamental investment strategy that involves purchasing an asset when its price is lower than usual. However, it's important to note that this doesn't mean you should invest all of your money at once when the price is falling. Instead, it's advisable to gradually average in as the price drops or wait until it settles before investing. It's worth mentioning that this approach is much safer to use when the market is bullish or when the economy is stagnant and the main trend is either up or sideways rather than in a volatile market. Therefore, if you're looking to generate passive income, starting with smart investments is crucial, and buying the dip in today's market could be the best possible move for building a thriving digital wallet. By investing in assets with the potential for growth and keeping a long-term perspective, you may be able to maximize your returns and secure your financial future. Buying the dip strategy. Well, when it comes to using the buy the dip strategy, there are a few different approaches you can take to help minimize risk and maximize returns. One approach is to accumulate small amounts of cryptocurrency when the price falls, building up an average position. By doing this, you can purchase more as the price falls even further, creating an average price instead of hitting volatile spikes. This can help you avoid getting caught up in the hype and making impulsive decisions. Another approach is to keep your money in the bank until the price has stabilized and possibly even begun to recover. This is called buying a reaction off of support, where you wait for the price to hit a level of support before investing. This approach can be particularly effective if you have a long-term investment horizon and are willing to wait for the market to stabilize. Finally, another strategy is to allow for the fulfillment of buy orders at lower prices. This involves setting buy orders immediately before historical support levels, massive buy walls, and psychological levels. This approach can be particularly effective in the stock market because prices tend to make at least a brief recovery from these levels. No matter which approach you choose, it's important to keep a level head and not get caught up in the market's volatility. By taking a strategic and measured approach to investing, you can potentially build a strong portfolio and generate passive income over the long term. But is buy the dip a good strategy? Essentially, the idea behind this strategy is to buy an asset when its price has fallen below its intrinsic value, with the expectation that the market will eventually recognize the asset's true worth and the price will rise again. However, while this approach can be successful in traditional financial markets, it can be more challenging to execute in the volatile world of cryptocurrencies. In fact, investing in cryptocurrencies at any price can be risky, and buying a dip that may ultimately turn into a prolonged downturn could leave investors with significant losses. Despite this, many traders continue to use the buy the dip strategy in the crypto market, hoping to capitalize on price drops and earn significant profits when prices rebound. To implement this approach effectively, traders can accumulate small amounts of the cryptocurrency as the price falls, gradually building up their position while waiting for the market to stabilize. Another strategy is to wait for the price to stabilize or begin to recover while buying, known as buying a reaction off of support. This involves identifying historical support levels, buy walls, and psychological levels where prices tend to recover and setting buy orders accordingly. Of course, past performance does not guarantee future results, and the crypto market is notoriously unpredictable. While the current dip may eventually bounce back as it did in the past, it's also possible that prices could continue to fall, leaving investors with substantial losses. Ultimately, traders need to do their due diligence, analyze market trends and risks carefully, and develop a sound investment strategy that aligns with their goals and risk tolerance. Although the crypto markets have experienced some growth since the beginning of the year, the current economic environment of high inflation and rising interest rates has raised concerns about the sustainability of this growth. It is important to remember that investing in cryptocurrencies, like any other investment, comes with risks and uncertainties. For instance, after the news of FTX collapse, Bitcoin's price fell to below $16,000, although it had been hovering around $20,000 for several months prior. Given the volatile nature of the crypto markets, it is crucial to exercise caution and adopt a long-term investment strategy. Oleg Gilberstein, the co-founder at CoinRule, advises novice investors not to try to catch falling knives, as many have been burned in the past. Instead, he suggests setting a predetermined amount of money to invest in BTC or ETH each month and not worrying too much about short fluctuations. Another strategy that can help mitigate risks is diversification. Pavel Matveev, CEO of digital exchange WireX, recommends diversifying your crypto portfolio with various altcoins. This can help to minimize the risks associated with investing in a single cryptocurrency while potentially providing greater returns over the long term. In summary, while buying the dip can be a profitable investment strategy, it is essential to exercise caution, diversify your portfolio, and take a long-term view of your investments. When investors follow the buy the dip strategy, they need to be cautious and ensure that they are actually buying a dip and not a long-term decline. It's crucial to understand the difference between the two, as holding onto a cryptocurrency that is on a long-term decline can be disastrous for your investment portfolio. For instance, you might be tempted to buy FTX at a 90% discount, but it's essential to evaluate whether this is a temporary dip or a long-term decline. In most cases, it's unlikely that FTX will recover to its previous levels, and if you invest in it, you might be left holding a lot of ugly cryptos. It's crucial to remember that buying a dead cat bounce is not a sustainable long-term investment strategy. Instead, investors should focus on fundamental analysis and market trends to determine whether a cryptocurrency price is likely to recover in the long term. By diversifying their portfolios and investing in different cryptocurrencies, investors can mitigate the risks associated with a single crypto's price decline. Are there alternatives to buying the dip? It's important to note that there are numerous alternative investment strategies for cryptocurrencies besides buying the dip. Success does not rely on this strategy alone. For instance, one can adopt a dollar-cost averaging approach by purchasing the same quantity of cryptocurrency at regular intervals. This method ensures that you naturally purchase more when prices are low, so you will not have to stress about timing the market. You will be buying on the same way down as well as on the way up. However, this does not imply that buying cryptocurrencies on the dip is not worthwhile. There is evidence to indicate that this strategy has worked with Bitcoin over the past decade. Nevertheless, at some point, when you are buying a cryptocurrency that has been discounted by more than 50% and it has been trading at this reduced level for a long time, it is no longer appropriate to say that you are buying the dip. You are now speculating and hoping that the value of your asset will continue eventually. Alright guys, that wraps up our video for today. If you found this video useful, please give us a thumbs up and hit the subscribe button for more.